great future. We're talking real money. Real money.
Hello, friends. Welcome to Talking Real Money, the radio show and then the podcast. I'm Don McDonald along with Tom Cock, and we're so glad you're listening, that you're there, and hey, that you're calling us at 855-935-TALK, 855-935-8255. As the executive producer of Talking Real Money, I am making an executive producer decision right now.
Calling the whole thing off?
To hold this hour's primary topic for a few minutes so that we don't break the flow, because it's a topic that we agonized over discussing.
Boy,
but we think I believe it's important enough to your bottom line and your life, because remember, we're talking about your money and your life. And so we're going to talk about a touchy subject that we're going to try and do tastefully. But before we do that, we're going to take the call that was waiting from the last hour.
Okay, I think that's just being nice.
Yeah. So let's go to Texas. Jim, welcome to the show.
Hey, guys. Yep, thanks. Thanks for being nice. Yeah. If you would indulge me, I've got three quick questions. I'm holding XLK, and I'm also holding QQQ, both of which are legacy holdings from my old financial advisor. I don't want to sell both of them this year, or actually next year. I don't want to sell both of them because of capital gains exposure. Which one of those would you sell? Could you compare and contrast those two?
Okay. They've had a good run. Yeah. Just looking at XLK in terms of how much it's costing.
Jeez Louise.
One of them seems to have more of the Fabulous Five than the other, which makes me nervous, right?
Well, they both have a lot of it. Trust me.
Yeah, but the tech is going to have more of those.
Yeah, it will have more.
Yeah.
Let's see.
I got to tell you, because of the concentration of XLK, that would probably be the one I'd start picking on first.
That's only 9 basis points too, so that is cheap.
Yeah, but QQQ's cheap.
Yeah, they're both cheap.
Yeah, they're both cheap.
Yeah.
I mean, how big a part of the? Let's just unpack this a little bit before you get to the other two questions. How big a part of your overall portfolio do these two holdings make up?
Maybe 2% each.
Oh, well. Then, I mean, if it was a tax thing and it was going to cost me, I might just keep them. I don't think I'd mess around with it if it was only 4% of my portfolio.
Or I would sell them just in teeny tiny dribs and drabs over the next several years. Yeah, if they're not a major, I agree with Tom, if they're not a major portion of your portfolio, then heck with them.
Yeah, well, the reason I'm selling, the reason I'm going to sell one or the other of them is just for cash, to raise cash for my spending for 2025. And
okay, this is going to pay you.
Yeah.
Yeah.
I would sell XLK.
Yeah, that I would too.
Sorry?
I would sell XLK because QQQ is more diversified.
Next question, Jim. You're on the hook here. Go, man.
Next question is related to the same thing, which is raising cash to just live on for 2025. Going into my brokerage account, I was just looking at, well, if I just turned off the dividend reinvestments on all of the stocks in there, that would raise about, or project about, let's say, $70,000 worth of dividends that would show up as cash rather than reinvested.
Then why not?
No, okay,
anyway,
but that's not going to change your tax situation any.
No. It's not. It's just to raise cash. It's just to raise cash. We're not talking about taxes.
Okay, but that's another. So in a general sense, we recommend a total return has been more sustainable.
Yeah,
in other words, letting those reinvest and then taking it out.
But if turning those off, it saves him selling and rebuying elsewhere. So I know I'd be all for turning off the dividends if that's how much money you need.
Yeah,
we would have an argument with that in a general sense because, again, the longer to maintain the portfolio longer, you let all those build up in there. They're part of the portfolio, and then you're selling the stocks to create the cash. That's been the more successful.
But it's in a taxable account, which
Good point.
Yeah, I don't think I'd do it. But thanks for the call. We really appreciate it. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hey there, welcome back to our program. I'm Don, that's Tom. We've got kind of a big topic we want to cover with you. It's definitely money. It's definitely life. But, you know, every day in the United States, somewhere between 50 and 60 people on average are murdered. Every day. That's a lot of people. But a couple of days ago, I opened my paper, and there was a murder, an assassination, that shocked me. It shocked me, but it got me immediately thinking. And I'm talking about the gunning down of the CEO of
United Healthcare.
United Health.
Yeah.
Which is part of the bigger company, United Healthcare, which, by the way, curiously enough, is the fourth largest company in America in revenue.
By revenue, not by market cap.
They make a lot of money.
Yeah.
Anyway, I got up, I opened my iPad, I read the New York Times.
You said paper. You haven't seen what paper looks like in a long time.
Do you know, we still call video recording somebody taping.
I know.
And nobody uses tape.
I know. Not for a long time.
I read my paper, in air quotes, and I saw that he was shot and killed. And the first thing that came to mind was, that is a disgruntled United Healthcare customer. And it seems they haven't found him yet. They may have by the time this airs as a podcast. We don't know. But it looks like it was. And while no murder is justified, the fact of the matter is there are a lot of murders that happen every day in this country for all kinds of reasons. But every once in a while, somewhere in the world, a murder happens that changes the way we deal with changes the world. A perfect example, back before World War I, when Archduke Franz Ferdinand was assassinated.
Yeah, that's true.
It led to the deaths of millions of people. That event started World War I. No one disputes that fact. This, I hope he didn't die in vain, because what this seems to have done is sparked a conversation about the problems with our health system, particularly the health insurance industry, which, by the way, I have had some really depressing dealings with as I've gotten older, and my health has deteriorated, and that of my wife.
Yeah. Now, you've seen, okay, just so we put it all on the table. We talked about this off the air. Don's situation is 180 degrees from mine. I've barely had any interaction. I had a couple little kerfuffles a few years ago, but I've never spent the night in a hotel, in a hospital. I've never been denied for none of those things have ever affected me, or for that matter, for my family. And those, again, to be completely upfront, my father was a physician, and he had a relationship with the insurance companies that was distasteful. He did not like insurance companies.
He didn't like them.
And that was 50 years ago. That was a long time ago. And I don't think things have gotten better. So when Don brought this up, I said, let's not do this, because
I think it's
I'm already getting the text from people that we're doing this. But I went and looked at a few of the numbers. There was a survey in 2023 that said the majority of adults have had at least one issue with their health, health payouts in the span of a year, at least one. 81% in that same survey said health insurance is good or excellent, but then 25% said they've been denied claims that resulted in delayed treatment, which is, as you may well know, that's pretty abhorrent. If you're in a situation where you're sick, you need help, and you can't afford it, and you're waiting for your insurance company to step up and take care of it, and they're not. I mean, that's troubling, right? Because you think, well, wait, I paid into this. I should get the treatment I need.
But what they're doing is they are trying to find any legal way to pay less and keep more of those premiums so that their revenue stays high. And I know that from personal anecdotal experience. A couple of years ago, I had neck surgery done. I had cervical spine surgery done. And my very good neurosurgeon, 6 months later, wanted a follow-up CAT scan to see how it was healing. The insurance company denied that CAT scan, even though he wrote them everything saying it was medically necessary.
And did you go ahead and pay for that on your own then?
I did.
You did.
Then
we want to make clear, by the way, just again, because I've already gotten 2 texts. In no way are we saying it's justified to kill the CEO of a company based on what the company.
No, I'm just talking about this as an event.
Right.
That, sometimes
creates conversation.
It creates conversation.
Yeah.
This event is abhorrent. You do not shoot people, but the problem is 20,000 times a year we shoot each other.
Well, okay, but setting that aside for a moment,
horrible.
I think more interesting at the moment is the number of people that have said, well, wait, this is a horrible way to die, but then my relative died in a horrible way because this company didn't pay for their treatment.
You cannot convince me.
That's conflation, though. You can't. You shouldn't.
It's not conflation. You cannot convince me that there hasn't been at least one death, and I know it's more, attributable to a insurance company not allowing a claim.
Oh, sure there has. Of course.
So is that a murder?
Gee, I'm not capable of making that moral decision.
Nor am I. But I'm raising the question.
Yeah, I think that's fair.
And
but the question on the table still, if you step back, because we spend, as I looked this up, number 2, we spend more on healthcare in this country on a percentage basis than any other developed country by far. Now, why can't, if that's true, and I think I have shared sometimes what how much I pay out in premiums. Okay, and that's fine. The coverage is great. I'm spoiled. I give you that. But if that's true, why can't we get the help we need for at least most people and not have a situation where people are paying premiums and not getting coverage they think they're due? That's a reasonable thing to discuss, I believe.
And it's not just the insurance companies, by the way. The system is broken from top to bottom. From top to bottom. The insurance companies, of course, and there really shouldn't be. Should there really be a middle person between you, profiting between you and your physicians?
That's a legitimate question. The profit is what you point out there.
Yeah.
Right. They're in the business of saying no to you and yes to, that's now, in the middle of your health care. I think that's a reasonable question to be asked.
They will argue, look what the hospitals and the doctors are charging us. And, those costs and they've got a legitimate beef there. As a matter of fact, I have another anecdotal, fascinating bit of information. Just recently, I'm suffering right now at this very moment, as a matter of fact,
I can attest to that.
From an attack of arterial fibrillation, or AFib. My doctor, my cardiologist, admitted me to a hospital for 3 nights to monitor me on some drugs to take care of it, which apparently they're not doing. I was in a hospital room in the Orlando area for 3 nights. The insurance company was billed for those 3 nights.
How much?
You ready for this?
Hardly wait.
$107,000.
Now, I've stayed in some nice places before, but I never spent that kind of coin.
I said I want a whole team of doctors and nurses
huddled
and the
me.
Ritz-Carlton suite, top floor, for that. But no, here's the problem.
Wow.
See, if I had no insurance, my bill would have been $107,000.
And you would have then done a bankruptcy, and then that would have been that.
However, because the insurance company's not going to pay $107,000, they got a $94,000 discount. So they paid $12,205, and I paid $826. Now, there's another problem with the system. The price is not the price. So I want to talk a little bit about this. Join us at 855-935-8255.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Our phone number is 855-935-TALK, 855-935-8255. By the way, there is no easy answer to this conundrum we face with health insurance, health care, health costs. By the way, it's not just the hospitals. It's also the pharmaceutical companies. Another fascinating example. I take Eliquis now because of my AFib. It's $560 a month to the insurance company, of which I pay right now, because I'm paid everything out of pocket, $0. $561.
But next year you're going to pay something more.
Yeah, that's how much the insurance company actually paid the pharmacy for it. They paid that much. However, I can go, if I was living in Canada, that exact same drug without any special
just walking in and buying them.
Just walking into the pharmacy, $75.
Wow, that tells you something. It's not good.
What does this say about the system? I'm sorry. I don't even think this can be a political thing anymore. I don't think this can be political because we are literally talking about deciding whether someone can live or die at a corporate level based on, by the way, a flawed AI program that United was using to decide some of these.
Oh, to decide the coverage?
Yeah.
Wow.
As a matter of fact, they have doctors who help them decide, and the doctors are compensated based on how many claims they deny. What do you do about this?
Yeah, it's so complicated that it's hard to know where to start, I guess would be the point.
I agree. It's hard to know where to start. And I'm not saying the government is going to be any better if we went to a single-payer system like Canada or Great Britain or much of Europe, most of Europe, all of Europe, pretty much all of the world except the United States has a single-payer system. But the government's a mess, too. So it's going to be inconvenient. But I have to tell you, I am 68 years old, which means my health, it deteriorates as you get older. Things happen. In fact, I'm feeling that AFib right now. But the fact of the matter is I pay out, and I have private insurance through my company, as does Tom. I pay out of pocket every year about $24,000.
Wow. 20 for the two of you for other stuff that you got to pay for.
The insurance premiums, which are $600 and $600 and change a paycheck, and then we always meet our max out of pocket between us. We always meet it, and that's another $6,000. So about $24,000 a year we pay out of pocket. I am serious. And by the way, this is a good reason to come to Retire Meet. I'm going to plug Retire Meet here.
Oh, because Kevin's going to get up and talk about Medicare.
Kevin Peterson's going to talk about Medicare. And I got to tell you, I am going to call Kevin in the next week or so.
You're going to switch over, aren't you, next year?
Be prepared. I am honestly thinking about picking up the rest of – I have Part A because that's you get that. But I'm honestly thinking about switching from private health insurance to true Medicare, not Medicare Advantage, because that's just United Healthcare doing it to me again. And by the way, if I switch to Medicare, there was an article today, I think it was in the Journal, about those who switch to Medicare cost the government 27% more. I don't care. Because I've
27% more than
because the United Healthcare or Blue Cross, they're controlling what they pay to doctors by denying claims and things.
Okay.
And Medicare pretty much pays everything.
Yeah.
So are they paid the Medicare rate, I should say, the Medicare rate. I am seriously considering, because I've run the rough numbers, and my costs per year should fall to about $12,000 to $15,000.
So half.
Yeah.
Yeah, that's a lot.
That's a lot.
It is.
So if you have any ideas, we would love to hear them. I don't know what the answer is.
There were on the Wall Street Journal comment, there were like 20,000 comments. I mean, so many people. I don't know if I've ever read that many.
It was in the 40,000 the last time I looked at the Washington Post.
A lot of people who have a lot of stories of pain. Of pain of seeing people not treated, of pain of being denied, of pain of being delayed. All the things you heard about the last few days.
I am 98% sure that this young man, when they find him, dead or alive, will find out that he had a loved one to whom something horrible happened because of a denial of a claim or a prior authorization. And that, to me, I mean, if I couldn't work for one of these insurance companies, I could not work for them. I would have to quit. I couldn't justify it. I could not find a way to justify turning sick people down. Could you?
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Maybe the solution is going to lie in technology. You know, because there's some cool technology. Just during the break, I thought, I'm going to check my AFib. And, of course, I can do it with my watch. Which, by the way, my doctor poo-pooed until I printed him up all the EKGs, and he went...
He didn't think it was accurate?
He went, oh, these are really good. So, yeah, you can see my watch right there, Tom. See that?
I do, yeah.
See that yellow screen? That
Yes.
Arterial fibrillation.
I think you should take the rest of the show off.
You can check it on your watch now.
I can't because I don't wear one, but yes.
By the way, they just there was a very, very in-depth study done, and they found that AI in diagnostics beat doctors, diagnosticians, in correctly diagnosing illnesses.
You go right ahead and go to the computer. I'm going to stick with the doc. So you do what you're saying. I said I have a bias because my dad was one. So.
And it's funny because the doc and the AI did worse because the doctor overrode the AI saying, I know better than the AI. I'm the doctor.
Right.
I'm going, ego.
That's just a machine.
Ego. There's profits and ego that get in our way as human beings, I think. Profits and ego. 855-935-TALK is our phone number. 855-935-8255. Anything money we can talk about. We are open to whatever it is that concerns you, that's bothering you, that you need help with right now when we're live on the radio, which we are on Saturdays from noon to 2 Pacific on Northwest News Radio. 855-935-TALK. It's free and it's really easy. And we have lines open right now. And, you know, we like ETFs. We like ETFs, exchange-traded funds. Took us a while to come around because we're pretty darn cautious. But, wow, ETFs have taken in $1 billion.
No, trillion.
I'm sorry.
Trillion.
That's a T, isn't it?
Yeah.
$1 trillion this year. That's a lot of money. That is real money.
They're at $10 trillion now.
That's a lot more money.
It is. And I apologize if I missed. I did
mutual
on the
mutual
notes
funds
here,
dead?
$1 billion. Personally, I think in 10 years, going to be very little money in mutual funds. That's just my take. But here's the interesting part about that. Here's the part where people get confused. They see any ETF and say, well, those guys on the radio said ETFs are a good idea. I'm going to go invest in these ETFs. Guess what type of ETFs have been rolled out more this year than any other type?
Gonna go out on a limb and say active.
Yeah, actively managed derivatives, leveraged, juice returns account for the 80% of the new launches this year. 80%. Because the people that run the financial services industry know they're no dummies. They see the trend and they say, wait, we want to be on board with that. And if we're just in those stodgy old mutual funds, people aren't going to give us their money, which they're not. In fact, people are pulling billions out of mutual funds and moving it into exchange. So they're saying, sure, we got to have our products out there. Which range, of course, from lovely cryptocurrency to leveraged individual stocks, all kinds of junk that you need to avoid. But in a general sense, exchange-traded funds, I think, are going to be the better way to go for, if you buy them correctly, low cost, for the liquidity and the tax-friendly nature of this. Again, as we've mentioned, it's pretty easy to figure out because they're called exchange-traded funds. Inside of the fund, they exchange the securities rather than sell them. When you sell them, you book a gain or a loss. When you exchange them, you do not. So it saves you on the taxation there.
Did you say low fees? Did you say
What'd
that?
you find? Yeah.
Did you say
again,
low
I guess.
fees?
I'm guessing. Yeah. Okay.
Well, you know, let's start at the lower end of. We're talking about an index fund, by the way, an index ETF.
God. Yeah.
From Van Eck, their Africa Index ETF.
Let me get. Wait. Don't tell me. Don't tell me. I'll say 0.81. They're laughing at me because I'm not making any money.
What? 1.31.
Okay, please don't pay anything like that.
Oh, wait. There's more.
Africa Fund? Which countries are they investing in Africa? That's kind of
African
limited.
countries.
Well, okay, thank you for that.
The Van Eck Muni Income ETF. They're just invested in muni bonds. It's the total muni bond index.
Which is, yielding 3.5% right now, or 3%.
I mean, come on. Those fees can't be high, right?
How much?
1.98.
No, that's insanity. Literally.
Oh, sir, you ain't seen insanity yet. Let's
go. Check that
Wait,
watch
you know
again.
what? I'm going to save these for the next segment because I'm telling you, you're going to be blown away.
I said. Don't be Don't. ETFs in and of themselves are not the right thing to do. Pay attention.
Oh,
That's
but you got to pay attention to some of these because it just gets better from here. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Previously on Talking Real Money, we were discussing the low fees of ETFs.
Tom said put everything in ETFs except for the ones that charge you 2% a year.
Yeah, and the one I was talking about was the Van Eck CEF Muni Income ETF. Now, what does CEF stand for?
I don't even know.
Closed-end fund.
Oh, it's a closed-end.
So they're buying
okay.
closed-end funds of municipal bonds
inside of
an index fund, which is crazy, and that's at 1.98%. In essence, too. But
they're not the worst, is what you're getting at here.
Oh, not by a long shot, sir.
We have
the Wisdom Tree.
Well, a reputable outfit.
Very reputable, and this is. A lot of people we know suggest using alternative investments.
Absolutely.
A lot of people we know. And this fund is one I've heard discussed before.
Which is?
The Wisdom Tree Alternative Income Fund. It buys high-yielding
private
securities that pay out high income.
But these are private notes, private loans, private?
No, there's some public, and it's a mix.
Okay.
And it's merely 4.3% per year.
Wow.
Now, let's put that in perspective, okay? The Vanguard S&P 500 ETF. Now, this Wisdom Tree is 4.3%. The Vanguard 500 ETF is not 0.3, 0.03%.
Okay, those are two very different products. So, but let me ask another question.
But I have one more for you.
You just can't help yourself when it comes to this. This is Christmas for you. Yeah.
This one comes from a very reputable old firm. Old firm. Putnam. You've heard of Putnam?
Yeah, it's been around forever.
And it's another one that invests in alternative income securities. And its expense ratio for the ETF is a mere... I can't even believe this number. Okay, you holding on?
I'm going to fall down, I'm afraid, yeah.
14%.
As in 14%? Really? 4.0%. Wow. Yes. Okay. All right. I'm glad you found those things. That's good. But here's a question for you. So, but if we told you to go buy a fund at Vanguard, to go buy a fund at Avantis, the exchange traded fund, or go buy a fund at Dimensional Funds, here's the question, are all of those fairly priced? Now, does Vanguard have any active funds that are exchange traded funds? Because they may have some that are somewhat expensive, because if they've moved their active stuff over, Vanguard's not perfect. They've got good funds, good index funds, widely diversified, but they also have actively managed funds. And some of their mutual funds are that. I just don't know if they've moved over to the ETF platform using those same strategies. If they have, they're going to be overcharging people as well.
Well, I'm looking, and let's see. The most expensive ETFs I find at Vanguard are in the 0.2%
Okay,
range.
This is important because we can tell you that you could go buy a product at Vanguard, exchange traded fund. You could go buy an exchange traded fund at Avantis, and you could go buy an exchange traded fund at Dimensional, and I think get treated fairly.
Yeah. Now, let me tell you, you will get charged more at Avantis or Dimensional than you will at Vanguard for two reasons. One, Vanguard tends to be a traditional indexer, which is a less expensive way to manage money. Two, they're the biggest money management firm in the world.
Are they?
No,
They're bigger than Fidelity?
They're bigger than Fidelity. Yeah, I think
I
they
always
manage
forget
more money.
Yeah, State Street. Yeah, it's hard to remember who's where because anyway, but they're all big. I'm sorry,
they're number two. BlackRock I always forget BlackRock.
Yeah.
They're
Larry
number
Fink.
2, Fidelity's number 3, State Street's number 4.
But for those of you playing along at home and saying, look, I really want to have some exchange traded funds, I think you can trust any of those three outfits.
Any of those, actually, you can trust probably.
You could add in.
Yeah, you can add in, for the most part, Fidelity, for the most part, BlackRock, for the most part, State Street. You can add those in, too.
Yeah, okay.
Yeah, because
fair enough. But everybody else tricks you. I think what you find is they come up with, here's generally what happens. By the way, 400 exchange-traded funds have shut down in the last year and 11 months. So great ideas come along, great ideas go away. So what you find is these people say, well, wait, we really should be investing. I'm sure somebody at Van Eck thought it was a great idea to be investing in Africa because there's a lot of opportunity there. Or somebody said a single stock exchange traded fund. Whoa, you could own partial shares of NVIDIA and ride it straight to the moon. There's all these ideas. You don't want to purchase things based on ideas. Ideas come, ideas go. That's why so many of these funds have gone out of business in just the last couple of years. There's almost 4,000 now exchange traded funds, but to have 10% of them gone in a couple of years tells you everything you should know, because these people, they come up with ideas, they overcharge you, they get into a sector that had worked for a while, and then it peters out, it goes away, and it doesn't work. What you want to do is, as we've talked about ad nauseum on this program, have the plan, build the right portfolio using low-cost exchange trade funds, the right ones with those families we mentioned, and not chasing the things that come along. Because there are, what did Eugene Fama say? There are 50 new ideas a week from Wall Street, whatever it is, 500. It's a lot of ideas every week. That's what the exchange traded fund world is turning into.
Five ideas that have ever really been meaningful over a long period of time. And it is encouraging when I look through the funds with the high expense ratios and I discover that all of them have relatively small amounts of money in them.
Yeah, but they're coming out with them. That's where,
like the Africa fund is like $10 million.
God's sakes, the Africa fund.
Now the Putnam at 14% shocked me. It has $150 million, but it's still in the grand scheme of money managers. And that's a fund of
closed-end funds.
No. The Putnam was not. That was the Van Eck.
Van Eck. That's
the Van Eck. The Putnam was really a fund of other, like Lending Club and those kinds of things.
Okay. So you don't want ideas. You don't want high expense funds. You can trust a few of those families. That's how you should buy exchange traded funds. And should you be using them instead of mutual funds? I would be. I'm not saying there's no good mutual funds.
Which one should I pick today based on the current market, Tom?
I would go with the global portfolio.
Gosh. You're going to give an answer?
Oh, pardon me.
I just set you up.
Oh,
based
for
on
today,
the current
as
market,
of today.
Yeah.
Short it all. Get in inverse all the way, maybe 3 times short.
All of the uncertainty in the market.
Kidding. Yeah, don't buy anything because of any uncertainty. There's always uncertainty. We had the great call recently from the woman who said, well, now with the election, blah, 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 and that's behind us, I'm more nervous than ever. And you asked a very good question. She's been around for a few decades. You said, was there ever a time where you just said, well, everything's great now, I don't got to worry about anything?
No. Was there ever a time in your life where you said, I've lived long enough that I know the future now. I can predict the future. I know I can do it infallibly, consistently, and over long periods of time. I know it. No. The older you get, the more, as a matter of fact, we believe in the future prognosticative ability of people when we're young.
Yeah.
It's over time that we
smarter.
go. Yeah. Nobody gets this right, and there's research to back that up. Really robust research. Check it out. We'll be back. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We have a few more minutes left in our hour that we generally, it's close to an hour. Take out the commercials and the traffic and,
about 36 seconds.
36 minutes.
Oh, 36 minutes.
Not 36. Wow, you in your note, you said $1 billion in ETFs.
I know, I had that wrong. It was even $1 trillion, and now 36
then you went
seconds.
To seconds.
I had decimal place problems. It started in about third grade, I think. I got to get that decimal point in the right place. So, anyway.
I didn't know there was a decimal point problem. Were you diagnosed with a decimal point problem as a small child?
Let's just say it this way. I'm not going through the healthcare system to find out, okay? I'll do it on my own.
That's probably smart because...
That's probably right.
And, nobody... It's funny, nobody had a solution.
I know.
Not a soul had a clue because it is a problem that... It's astronomical.
It is.
Percent? Did all your research, what percentage of U.S. GDP goes to healthcare.
It's a big number. But while you're doing that, can I tell them about something where we're trying to help you to try to solve some problems, and we think we can do it in the better part of a day? It's called Retire Meet. For the last decade, we've done this. It's sold out every year in Bellevue. And we're going to do it again February 8th. The inexpensive tickets are on sale right now. We've already sold a third of the room out. Here we are. It's December 7th.
People are frugal. They want those cheaper tickets before they get expensive later. Because right now, the tickets you get make lunch and breakfast a bargain.
Yeah. So it's the
Even if you don't get any information, if you just come over and eat, you did well.
Indeed. So the two of us will be there. Paul Lupescu from Dimensional Funds. Our friend Paul Merriman will be there. Joe Saul-Sehy from Stacking Benjamins. You mentioned Kevin Peterson will be there. We have an estate planner. We got everybody, all these angles of retirement covered in one day at Retire Meet. And you can register right now and get the early bird tickets by going to retiremeet.com. Did you get the answer you're looking for?
Yeah, about 17% of U.S. GDP goes to healthcare. 17%.
Wow. One out of every $5. That's a lot.
That is a lot. And healthcare costs in the U.S. are about $6,000 per person more than any other similar country.
You would think with that we could fix a lot, but again, I'm not smart enough to figure out how to do it.
I know what the problem is.
Oh, okay.
There are too many middle people.
Too many people between you and your doctor.
Exactly. And they're all taking a little cut along the way.
No, that is a problem.
And that cut isn't, a little cut. That cut isn't little. If it's big enough to make United Healthcare the fourth largest revenue in the country.
All right.
It tells you there's a problem. And I hate that somebody has to die for us to talk about that. But, it's the first time we've ever talked about it.
It is on the show.
And I think it's worthy of discussion. Not of smart-ass comments. You notice I didn't quote any of the smart-ass comments that people made.
There's a lot of those out there, yeah.
It's not it. This is too important to be a smart-ass about. So stop it. Be a dumbass about it. No, that's wrong.
But
too.
you can be smart about your retirement. You can join us on February 8th, 2025. Trust me, this will be sold out in the next month. I know I've said that before, and I've been right every time. So join us.
Oh, he hates it. I hate it when he's right every time. And also, if you want more information on some of the things we do, like helping you with your money, or you want to ask us some questions, you can write your questions or speak your questions at talkingrealmoney.com. Just click that button in the upper right corner that says Horner. Little Jack Horner sat in the corner and clicking the Contact Us button at talkingrealmoney.com.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.